I'm Frankie, welcome back to my fuck show. Today, I want to talk about Tesla. Although it is a company that made more than 100 times return for its investors, many old school investors like Michael Burry still thinks Tesla is a bubble waiting to burst. As an old school investor myself, I have my reservations too. Tesla is a company that needs no introduction. It envisioned creating the most compelling car company of the 21st century by driving the world's transition to EVs. More importantly, Tesla intends to accelerate the advent of sustainable transport by bringing compelling mass-market electric cars to market as soon as possible. The key words here are mass market and as soon as possible. This means that while other car manufacturers are positioning EV as a premium product today, for Tesla, screw that. To them, everyone should own an EV and people should change their cars to an EV today. With that business direction in mind, Tesla has been pooling all the resources it could get its hands on to fulfill that strategy. Today, many car manufacturers are struggling with supply chain issues to produce more cars. Despite having the same issue within Tesla, they were able to make 5 consecutive quarters of record vehicle deliveries based on its latest announcement, with 71% CAGR since 2017. As the CEO of Tesla, Elon Musk said that Tesla deliveries are probably the fastest that any large manufactured object has grown on the planet. If this did not impress you yet, the management is confident to maintain that growth in the next few quarters. At times when supply chain is a big headache in the manufacturing industry worldwide. Imagine if there wasn't a chip shortage today, what growth number would that be?
We were on the verge of greatness. We were this close.
In terms of product rollout, the Model 3 is the best-selling EV model globally today. But Tesla thinks that the new Model Y will surpass Model 3 and become the best-selling model of any kind in 2023. Any kind. That's quite a statement to make. It's like saying none of the other car manufacturers even qualify to be Tesla's competitors. As an investor, never take the management's word for it. The best way to go about before making an informed investment decision is always to look into the company's books. For a company like Tesla, I expect very high capital intensive investments in order to fulfill its business strategy. In fact, that is true. The company just added 3 new gigafactories to mainly focus on the production of the Model 3, the future Model Y, and battery packs. Again, the dedication of the Tesla team has successfully pushed the new Giga Shanghai plant so much that despite being a new factory, the production has already surpassed Tesla Fremont factory, which is Tesla's main production hub that it acquired from General Motors back in 2010. On top of the 3 giga plant that caters for Tesla's hungry growth, the company is still pushing the existing Fremont factory to increase the production by 50% more. The point I want to make is that with such an aggressive expansion plan, it comes with hefty costs and a huge operational risk. However, Tesla is able to register a free cash flow of over $4.2 billion in the last 12 months, although it is still undergoing a gestation period to reach an optimum production stage. That's impressive. Once the teams in those respective new factories get the hang of operating the giga plants more efficiently, I just couldn't imagine how much more free cash flow Tesla could generate based on the current trend. Did I mention that Tesla has its own capabilities to make its own batteries? Yet, it is still buying tons of batteries from all over the world. To give you some perspective, Tesla vehicle sales only accounted for 0.7% of the market, but it bought 26% of all cells used by the entire automotive industry in 2020. The amount is so crazy that even Tesla's battery suppliers are afraid of them. They are worried that Tesla's huge battery orders would make the existing battery suppliers become so reliant on Tesla, and then one day if Tesla decided to cut them off, they would all go out of business.
You're fired. You're fired. You're fired.
The thing is, when you have factories that are being labeled as giga plants, it will only make sense if you intend to seriously flood the planet with your products. And in order to do that for Tesla, one key move would be to buy up all the available battery cells that it could get its hands on. In the recent shareholders meeting, Elon Musk mentioned that even if battery suppliers were to double their selling price to Tesla, he would still buy all of them off. So much for the things that I like about Tesla. Now, why do I hate it? First of all, With so big of an expansion plan, what if the world is not ready for it? In fact, the world is really not ready for it, especially for oil exporting countries like Malaysia, the Middle East, Russia, and the US. And that's the reason why EV adoption in the US is so low today. The new EV car sales only accounted for 2.4% in the US last year, falling way behind China and the EU. It is going to be within the political agenda of such countries to at least exhaust all their oil reserve first before unleashing the true potential of EV within their jurisdiction. If not, their oil reserve would essentially become worthless. According to a simple Google search, the world oil reserve today is able to last us for the next 50 years. If this is true, the transition from an ICE vehicle to EV will really take a while to achieve, and companies like Tesla would eventually hit a bottleneck at a certain point in time. This bottleneck will happen when the transition among the middle upper income group of the world to EV is completed, because this group of people are the only ones who could afford the premium price of an EV today compared to an ICE car. Moreover, the government of oil exporting countries may not want to install EV infrastructure in their countries yet, making EV ownership rather inconvenient. Of course, the argument from Tesla on this thread is that the value of the company is to continue to accelerate the adoption of sustainable energy. It is going to flood the world with Tesla products until eventually everyone has no choice but to use it. It is a noble thing to do, but it is also a head-on battle between Tesla and many governments in the world that produce oil. Secondly, actually Tesla does not just make cars. The group also ventured into solar power business, particularly solar panel and solar roof, which are equally interesting projects. Apparently, the solar cells that Tesla produces are said to be able to yield higher energy compared to normal solar cells. Moreover, the solar roof really looks slick and beautiful to be installed on a building. You should check it out on their website, and I bet you would agree with me on that. The thing that puts off a lot of old school investors on this business venture is that the management is picking all the brains it could get to focus on building EVs instead of expanding the solar power business venture. This includes transferring engineers from the solar power business into its car manufacturing operation. As a result, this business segment becomes a very small contributor to the entire group revenue today. This kind of ruthlessness in the business planning is risky, and many old school investors would penalize the management of a company for failing to manage business risk effectively, although the current plan for Tesla seems to be working in their favor. As one of the world's richest person on earth, do you know that Elon Musk doesn't draw a salary from Tesla? Technically speaking, he has no income. His wealth mainly comes from the shares that he owns in Tesla. In fact, he is so poor that he sometimes has to take out loans using his shares as collateral. Nobody sees this as a problem today because Tesla stock is on a bullish trend. But what if Tesla wasn't doing that well and the share price keeps dropping? It will come to a point where Musk collaterals isn't enough to cover his loan position, forcing banks to force sell his shares position and press the share price down. In fact, we are already getting a taste of the effect of this structure today when Elon tweeted a poll to ask his followers if he should sell 10% of his stake in the company to fulfill tax obligation, causing Tesla shares to drop over 12% immediately. To give you some background on this matter, Elon Musk was given a share option in 2012 to buy Tesla shares at the strike price of $6.24 per share. At the current Tesla share price, his gain on shares total over $20 billion. But with a 54% tax obligation coming his way on this stock option, he will need to fork out $15 billion to pay his tax bills. For someone who doesn't have an income, the only way to raise that kind of money is to liquidate his shares holding in Tesla. And that is the risk that investors has to endure when it comes to investing in Tesla. As an individual who owns more than 23% of the company, nobody knows when he will sell his shares again next time for his personal commitment. Unlike other institutionalized organizations like Google, whereby the driver of a company depends on aligned interests of every level of an organization hierarchy from top to bottom. At present, Tesla seems like a company that depends heavily on one individual to drive the strategy and growth of the business. Elon Musk is a brilliant man, but without him, who could continue his legacy? I have yet to visualize, at least for me, what Tesla could be without Elon Musk. If Elon Musk is not in Tesla anymore, what do you think will happen to its shares price? That's all we have for today. #fuck.